One of the most important strategies to protect your investments from a stock market crash is to diversify your portfolio. Diversification means spreading your money across different types of assets, such as stocks, bonds, cash, real estate, and others, that have low or negative correlations. Correlation is the degree to which your investments move in tandem. If your entire portfolio moves together, you are not diversified. Why is diversification important? Because it can reduce the risk of losing money in a single sector or asset class. For example, if you invest all your money in technology stocks, and the tech sector crashes, you will lose a lot of money. But if you invest some of your money in other sectors, such as healthcare, consumer staples, or utilities, you may be able to offset some of the losses from the tech sector. Similarly, if you invest all your money in stocks, and the stock market crashes, you will lose a lot of money. But if you invest some of your money in bonds, cash, or real estate, you may be able to cushion the impact of the stock market crash. How can you diversify your portfolio? There are several ways to do so. Here are some tips: buy at least 25 stocks across various industries, or buy an index fund. One of the quickest ways to build a diversified portfolio is to invest in several stocks that represent different sectors of the economy. This way, you can benefit from the growth potential of stocks without being exposed to the volatility of a single sector. Alternatively, you can buy an index fund that tracks a broad market index, such as the S&P 500 or the Nasdaq Composite. An index fund is a type of mutual fund or exchange-traded fund, ETF, that holds all or most of the stocks in a given index. By buying an index fund, you can own a slice of the entire market with one investment. Put a portion of your portfolio into fixed income. Another important step in diversifying a portfolio is to invest some capital in fixed income assets like bonds. Bonds are loans that you make to governments or corporations that pay you interest and return your principal at maturity. Bonds can provide a steady stream of income and reduce the volatility of your portfolio. Bonds also tend to have low or negative correlations with stocks, meaning they often move in opposite directions. This can help balance out the losses from stocks during a market downturn. Consider investing a portion in real estate. Real estate is another asset class that can diversify your portfolio and provide income and growth potential. Real estate can be invested in directly by buying properties or indirectly by buying real estate investment trusts, REITs. REITs are companies that own and operate income-producing properties, such as apartments, offices, malls, hotels, or warehouses. REITs pay out most of their earnings as dividends to shareholders, which can provide a steady source of income. Real estate also tends to have low correlations with stocks and bonds, meaning it can perform well when other assets are struggling. These are some of the ways to diversify your portfolio to reduce the risk of losing money in a single sector or asset class. By following these tips, you can create a more balanced and resilient portfolio that can withstand a stock market crash. One of the most important skills for any investor is knowing how to minimize the impact of a stock market crash. A crash can wipe out years of hard-earned gains and cause severe emotional stress. Fortunately, there are some strategies that can help you protect your capital and limit your losses in a bear market. In this section, we will discuss how to use stop-loss orders, hedging strategies, and cash reserves to achieve this goal. Stop-loss orders are instructions to sell a stock or an ETF when it reaches a certain price level. They can help you cut your losses before they get too big and preserve your profits when the market turns against you. For example, if you buy a stock at $100 and set a stop-loss order at $90, you will automatically sell the stock if it drops below $90, limiting your loss to 10%. You can also adjust your stop-loss order as the stock price rises, locking in your gains. For example, if the stock rises to $120, you can move your stop-loss order to $110, ensuring a 10% profit even if the stock crashes. Hedging strategies are ways to reduce your exposure to market risk by taking an opposite position in another asset or instrument. For example, you can hedge your stock portfolio by buying put options, which give you the right to sell a stock or an ETF at a specified price within a certain time period. If the stock or ETF falls below the strike price of the put option, you can exercise your right and sell it at a higher price than the market price, offsetting some or all of your losses. Alternatively, you can hedge your portfolio by buying inverse ETFs, which move in the opposite direction of the underlying index or sector. For example, if you own a lot of tech stocks, you can hedge your exposure by buying an inverse tech ETF, which will rise in value when tech stocks fall. Cash reserves are simply money that you keep in a safe and liquid form, such as a savings account or a money market fund. Cash reserves can help you weather a stock market crash in two ways. First, they can provide you with income and liquidity when you need it most, without forcing you to sell your stocks at a low price. Second, they can give you the opportunity to buy more stocks at bargain prices when the market recovers. A common rule of thumb is to have enough cash reserves to cover at least 6 months of living expenses, but you can adjust this amount according to your personal situation and risk tolerance. By using these 3 strategies, stop-loss orders, hedging strategies, and cash reserves, you can minimize the impact of a stock market crash on your portfolio and your peace of mind. Remember that crashes are inevitable and temporary, but they also create opportunities for long-term investors who are prepared and disciplined.